Chapter 3, Understanding Money Jargon. In this chapter, reading the spots, going forward, finding swaps, checking out options, looking for futures. Trading in the world of money means you must learn an entirely new language to understand what the traders are talking about. You'll hear traders talk about spot and forward transactions, swaps, options, and futures. This chapter introduces you to these terms and explains how you use them to trade foreign currency. Spot transactions. A spot transaction is the simplest type of transaction in the world of foreign exchange. It is simply the exchange of one currency for another. The spot rate is the current market price, also known as the benchmark price. The actual transaction does not require immediate settlement or payment on the spot. The settlement of a spot transaction happens within 2 business days after the trade is made, which is also known as the trade day. The trade day is the day the 2 traders agree to the terms of the spot transaction. This 2-day period gives the traders time to confirm the agreement and arrange for the clearing of the funds through a financial institution, such as an international bank. Remember, many times these transactions are taking place between traders in 2 different countries, in 2 different time zones, so it does take time for the clearing of funds. The only spot transaction in the United States with a settlement period of 1 day is the U.S. dollar to Canadian dollar exchange. Pricing spot transactions. Every currency being traded has 2 prices, a buying price and a selling price. The selling price is the price at which the sellers want to sell, and the buying price is the price at which the buyers want to buy. These are also known as the bid and offer prices, where the bid is the price at which a market maker will buy a specific currency pair, and the offer is the price at which the market maker will sell the pair. The market maker provides a quote with the bid and ask price for customers. The difference between these 2 prices is called the spread. Definition. In foreign exchange world, a market maker is a bank or forex dealer that provides tradable prices for specific currency pairs. Market makers add liquidity and provide a 2-sided market. International banks serve as market makers for more than 70% of the foreign exchange market. Retail or individual customers typically go through licensed forex dealers firms that act as market makers because these firms can access the prices and liquidity of the international banks while providing individuals with market access. Quoting spot exchange rates. Spot exchange rates can be quoted in 2 ways, as a direct quotation or as an indirect quotation. A direct quote is one in which the amount of the dominant currency, example, dollars and cents, if you are in the United States, is given per unit of the foreign exchange currency. An indirect quotation is quoted in the amount of the foreign currency per unit of domestic currency. For example, in the United States, a direct quote for the euro would be 1.25 USD equals 1 EUR, or 1 euro. An indirect quote would be 0.80 EUR equals 1 USD. You may also hear the phrase American terms. The phrase is used in the United States as refers to a direct quotation for US dollar per 1 unit of foreign currency. In Europe, you might hear the phrase European terms, referring to a direct quotation for someone in Europe from their currency per 1 unit of US dollar. If you're in the United States and hear the phrase European terms, that means you're being given the quote from the perspective of the foreign currency per 1 US dollar. In 1978, In an attempt to integrate the foreign exchange market into a single global market, the U.S. market changed its practices to conform to the European market. So today, most quotes are given in European terms as the foreign currency per $1 US. Another set of terms you will likely hear when talking about foreign currency trading on the spot market is base and terms currency. The base currency is the underlying or fixed currency. For example, in European terms, the US dollar is the base currency because it is the currency in the transaction that is fixed to one unit. The terms currency in the transaction is foreign currency being quoted price to $1 US. When you hear a quote, the base currency is stated first. When a market maker quotes a currency for a trade in the spot market, he or she quotes it at the price at which he or she will buy or sell the currency per one unit of the base currency. For example, suppose you request a quote on a USD/CHF spot transaction. USD is the IOS, which means standardized code for the United States dollar, and CHF is the IOS code for the Swiss franc. The spot transaction also be called the dollar Swissy. The market maker could respond with a quote of 0.9617-27, which means that the market maker is willing to buy CHF at a price of 0.9617 per $1 US and sells CHF at a price of 0.9627 per $1 US. When you get a quote on a currency pair, it is most often presented to the fourth decimal place. This is called a pip. A pip is the smallest amount that a currency pair can move in price. This is similar to a trick on the stock market. If a dollar is not part of the transaction, the exchange is done at what is called cross-rate trading. The base currency is always the currency listed first in the trade, and the pricing currency is listed second. Forward transactions. If you don't want to settle a transaction within 2 business days, you can also trade using an outright forward transaction. In this transaction, you trade one currency for another on a pre-agreed date at some time in the future, but it must be 3 or more days after the deal date. The forward transaction is a straightforward single purchase or sale of one currency for another. The exchange rate for a forward transaction usually differs from the rate for a spot transaction because the buyer and seller making the deal know the rates will fluctuate in the future and try to make their best estimate of what the future rate will be. When the forward transaction is executed, the buy and sell price is fixed, but often no money changes hands. Sometimes foreign currency dealers ask customers to provide collateral in advance. Who uses forward transactions? Companies use outright forward transactions for many different purposes, including future expenditures, hedging, speculating, and investing. One of the most common uses is to plan for a future expenditure. For example, a U.S. company that knows it will need to pay for parts from a factory in Japan will execute an outright forward transaction to be able to plan for the exact cost of the parts based on the forward transaction price. That way, even if the foreign exchange price changes dramatically, the company can still depend on the agreed price for the parts. Outright forwards in major currencies are available from dealers for standard contract periods, also known as straight dates. These periods can be 1, 2, 3, 6, or 12 months into the future. You can make arrangements for old dates or broken dates for contract periods in between the standard dates, but these type of trades can be much more expensive. Setting rates for forward transactions. When setting the rate for a forward, 2 factors impact the price: the spot rate of the currency and the interest rate differential between the currencies. In setting the price, the market maker neutralizes the impact of the interest rate difference between the two currencies named in the forward transaction. Although spot transactions are quoted in absolute terms, say X francs or X francs per dollar, forward transactions are quoted in differentials, which are premiums or discounts from the spot rate based on the interest rate differential. The differential is calculated in basis points to neutralize the difference in interest rates. For example, if interest rates are higher for the Swiss franc than the US dollar, the number of basis points calculated is subtracted from the base spot price for the Swiss franc to offset the differential. Foreign exchange traders know that for any currency pair, if the base currency earns a higher interest rate than the terms currency, the base currency will trade at a forward discount. If the base currency earns a lower interest rate, the base currency will trade at a forward premium or at above the spot rate. Swaps. If you don't want to buy another currency, but just want to borrow it for a certain period of time, you can use a foreign exchange swap, FX swap. An FX swap allows you to exchange one currency for another and then re-exchange back to the currencies you first held. Banks and others in the dealer market use FX swaps to shift temporarily into or out of one currency for a second currency without having to incur the risk of a change in the exchange rate, which could happen if they were to hold an open position. The use of FX swaps is similar to borrowing and lending currencies on a collateral basis. FX swaps provide traders with a way to use the foreign exchange market as a funding instrument. They are used by traders and other FX market participants in managing liquidity, shifting delivery dates, hedging speculation, and taking interest rate positions. There are two legs to an FX swap that settle on two different value dates, but it is counted as one transaction. The two parties involved in the swap agree to exchange the two currencies at a particular rate on one date, the near date, and to reverse the payments, usually at a different rate, on a specific date in the future. The far date, if both dates are less than 1 month from the deal date, it is called a short-dated swap. If one or both dates are 1 month or more from the deal date, it is known as a forward swap. Although an FX swap can be attached to any pair of value dates, in reality, a limited number of standard maturities linked between the near date and far date account for most swap transactions. The first leg, near date, of the FX swap usually occurs on the spot value date, and for about 2/3 of all FX swaps, the second leg, far date, occurs within a week. Longer FX swaps are available for 1 month, 3 months, or 6 months. Many foreign dealers arrange odd or broken dates for their traders, but the costs for those are higher than the standard maturities. Buying or selling. FX swaps can be either a buy or sell swap, which means that you buy the base currency on the near date and sell it on the far date, or sell/buy swap, which means you sell the base currency on the near date and buy it on the far date. For example, if you buy a fixed amount of pound sterling spot for US dollars exchange and sell those pound sterling 6 months forward for US dollars re-exchange, that is called a buy-sell sterling swap. Pricing FX swaps. The cost of the FX swap is set by the interest rate differential between the two currencies being swapped. The amount of interest that could be earned during the period of the swap is used by the dealer to calculate the price of the swap. In calculating the cost of the swap, the dealer uses the spot rate and adjusts it for the interest rate differential between the base currency and the terms currency for the number of days of the swap. This calculates the borrowing and lending rates for the currencies involved. The rates are then used in a second calculation to determine the swap points that will be added or subtracted to determine the price. Currency and interest rate swaps. In addition to FX swaps, there are also interest rate swaps, which involve an exchange of a stream of interest payments without an exchange of principal, and currency swaps, which include an exchange and re-exchange of currency plus a stream of fixed or floating interest payments. The currency swap gives companies a way to shift a loan from one currency to another or shift the underlying currency for an asset. A company can borrow funds in a currency different from the currency needed for its open operations. The currency swap provides protection from exchange rate changes related to the loan. Companies sometimes use currency swaps to gain access to a particular capital market otherwise unavailable to them because of currency restrictions in that particular market. They can also be used to avoid foreign exchange controls or taxes. Currency swaps are not as popular as interest rate swaps because interest rate swaps do not involve the exchange of principal, so the cash requirements and the amount of risk are lower. The two parties involved in an interest rate swap agree to make periodic payments to each other for a set period of time. The principal amount on which the interest is based is called the notional amount of principal, but the amount of principal does not change hands. The most common form of interest rate swap is one in which the payments are calculated by setting a fixed rate of interest to the notional principal amount, which is then exchanged for a stream of payments calculated by using floating interest rates or rate of interest. This is called a fixed for floating interest rate swap. If both sides of the cash flows are to be exchanged using a calculation based on floating interest rates, it's called a money market swap. Interest rate swaps are used by commercial banks, investment banks, insurance companies, mortgage companies, investors, trust companies, and government agencies for many different reasons. These are the most popular: to obtain lower cost funding, to hedge interest rate exposure, to buy higher yielding investment assets, to obtain types of investments assets that might not otherwise be available, to implement asset or liability management strategies, to speculate on the future movement of interest rates. Foreign currency options. You don't have to actually buy any currency to speculate in the foreign currency exchange market. You can buy a foreign currency exchange or currency option contract. This contract gives you the right, but not the obligation, to buy or sell a specific amount of one currency for another at a specific price on, or in some cases, depending on the contract, before a specific date or before a specified date. Options don't have to be exercised, meaning to actually buy or sell the currency. The holder can decide not to exercise his or her option. If the holder decides not to exercise the option on the specified date, the option expires. The holder doesn't have to come up with any funds on the specified date, but does lose any money spent to buy the option. There are two types of options. A call option is the right, but not the obligation, to buy the underlying currency on a specified date. A put option is the right, but not the obligation, to sell the underlying currency on a specified date. The person who purchases the option is the holder or buyer. The person who creates the option is the seller or writer. The price of the option is set by the seller and includes a premium that the buyer pays the seller in exchange for the right to buy or sell the underlying currency at some future date. The price at which the option is bought is called the strike price or exercise price. The buyer of the option only risks losing the amount of money he or she paid in premium to buy the option. The writer of the option risk is unbounded because he or she must come up with the underlying currency if the option buyer decides to exercise his or her right on the specified date in the contract. even if the cost of the buying or selling that underlying currency is considerably higher than when the option was originally written. Options have been around for a long time, but only started to flourish in the foreign exchange market in the 1980s. Their popularity was aided by an international environment of floating exchange rates, deregulation, and financial innovation. Currency options started on the U.S. commodity exchange, but are available in the over-the-counter market too. Options are very popular, yet they make up a very small share of foreign exchange trading. Wealth builders. If you want to trade in options, your best place to start is through one of the U.S. exchanges. In the United States, options on foreign currencies are traded on NASDAQ, OMX, PHLX, and the Chicago Mercantile Exchange. You can also trade options on the U.S. dollar index and on the euro index at Intercontinental Exchange, known as ICE. Forex dealers also offer forex options. Exchange traded currency futures. Another way you can get involved in the foreign currency exchange market without actually exchanging foreign currency is through exchange traded currency futures. These are contracts between two parties to buy or sell a particular non-U.S. dollar currency at a particular price on a particular future date. When you actually enter into the contract, no one is buying or selling any currency. It's just a contract with a promise to purchase a foreign currency at some future date. In reality, most future contracts are canceled before maturity, and only about 2% result in delivery. Futures contracts are primarily used as a tool to hedge other financial positions or to speculate in the foreign exchange market. You may think that futures seem to be the same as outright forwards, but they are not. Futures are traded on organized centralized exchanges that are regulated in the United States by the Commodity Futures Trading Commission. Forward contracts are traded over the counter and are largely self-regulated, so they can be a much more risky transaction. Definition: the Commodity Futures Trading Commission is a U.S. government entity that protects market users and the public from fraud, manipulation, and abusive practices related to the sale of commodity and financial futures and options. The Commission's mission also includes fostering open, competitive, and financially sound futures and options markets. The fact that futures contracts are channeled through a clearinghouse with the guarantee of performance on both sides of the contract makes them a much safer bet than forward contracts. It's much easier to liquidate a futures contract too, because there is an established futures market. Also, the high degree of standardization for the futures contract means that the traders only need to discuss contracts one wants to buy and the price for the contract. Transactions can be arranged quickly and efficiently. Forward contracts do provide more flexibility in settling. Forward contracts do provide more flexibility in setting delivery dates. They tend to be for higher amounts, sometimes for millions of dollars. Futures contracts are much smaller and are usually set at about $100,000 or less. A trader who wants to buy more than that buys the number of contracts needed to hedge or speculate in the dollar amount desired. You can trade futures on the same exchanges mentioned in the foreign currency options sections of this chapter. Comparing Forex. You're probably asking, is trading Forex worth the risk? And how does it compare to other trading opportunities, such as futures and stocks? Or should I stick to a less risky investment alternative? The section that follows discuss all these thoughts. Forex versus futures. Forex gives the traders many advantages over trading futures. The biggest advantage Forex has is that you can trade the market 24 hours a day, and trading only briefly closes on the weekends. It is rare for you to face a period of illiquidity, not being able to trade, in the Forex market, whereas you are limited to the times the exchanges are open in the futures market. If you hear news that could affect your position at almost any time of the day or night, you can trade on the Forex market, but you'll have to wait until the exchanges open on the futures market. This gives the Forex trader more flexibility and continuous market access, which just isn't available to the futures trader. Forex traders have the advantage of three main economic zones that are linked throughout the world to give them trading opportunities throughout the day and night. For example, when the Pacific Realm markets, which include Japan and Singapore, begin to slow, the European markets of England, Switzerland, and Germany are just getting started. When the European markets are in full swing, the North American markets open, which include the United States, Canada, and Mexico. When the United States markets begin to slow down in the evening, the Pacific Realm markets are just reopening. Foreign exchange is the principal market of the world. The monetary volume, $3.98 trillion a day, and participation in the Forex market far exceeds any other financial market, including futures or stocks, because the market is so large and available 24 hours a day. It is not affected by trading programs that can easily manipulate the stock or futures market. The Forex market offers a 24-hour daily trading opportunity, making it a heaven for traders who don't want to worry about gaps, differences between when the futures market closes and reopens, or price movements, erratic spikes, and other choppy market conditions that can be seen in the futures market. However, slippage can occur when a dealer's office is closed, during times of extreme market volatility, or during major fundamental announcements. Slippage is when orders are filled at a price worse than the stop price requested by the trader. If you study any market trading throughout the civilized world, you can quickly see that money is the root of all pricing. Global finance is distributed and redistributed using money through many different channels and different financial derivatives. Definition: derivatives are a type of financial instrument whose value is dependent upon another instrument, such as commodity, bond, stock, or currency. Futures and options are two different types of financial derivatives. Trading spot currencies can be done with many different methods, and you will find many different types of traders. You will find fundamental traders who speculate using mid to long-term positions based on worldwide cash flow analysis and fixed income formulas, as well as economic indicators. We talk about more fundamental analysis in Chapter 8. You will also find technical traders who watch for patterns and indicators in consolidating markets. We talk more about technical analysis in Chapter 7. Forex is where the big boys trade. That's all the major banking institutions in the world. But Forex can also provide the small speculator with the opportunity for large profit potential, although the trader also has to be prepared for the corresponding large risks of trading foreign currency. Another big advantage for Forex traders is that the fees are typically less than those found in the futures market. All traders, whether in futures or Forex, will find that financial instruments have a spread, which is the difference between the bid and the price at which the buyer will buy, and X, the price at which a seller will sell price. In the Forex market, you only have to worry about the spread. In the futures market, however, you often have to pay commission charges as well as clearing and exchange fees on top of the spread. Many currency dealers don't charge any additional fees to their customers for for trading Forex. Instead, they make their money through revenues as a currency dealer, including proceeds from buying, converting, and holding currencies. They also earn interest on deposited funds and rollover fees. So as a currency trader, you will be able to find commission-free trading at the best trading prices. A good currency dealer should be able to offer you a way to make quick decisions on your Forex trades without having to worry about how fees will impact your profit or loss. You also should not have to worry about any slippage between the price you see on your screen and the price at which your order will be filled. However, Forex dealers cannot guarantee that slippage won't occur when a dealer's office is closed during times of extreme market volatility or during major fundamental announcements. Better leverage is another advantage you can find when trading foreign currencies rather than futures. Trading using leverage is also called trading on margin. Spot currency traders have one low margin requirement for traders conducted 24 hours a day. Future traders can have one margin requirement for day trades and a different margin required for overnight positions. This can decrease the overall tradability of the currency futures market. Margin rates in spot currency trading vary from 0.25 to 5%, depending on the size of the transaction. You can find currency dealers who give their customers one rate all the time with no hassle and no margin calls. Definition. Margin is the amount of money deposited by a customer that is required to be deposited to the broker or dealer. Margin is a percentage of the Forex or futures position value. A margin call is a broker or dealer's demand on a customer to deposit additional funds into his or her account. Margin calls are made to bring a customer's account up to a minimum level. Forex versus stocks. When trading Forex, you can primarily focus your attention on four major currency pairs: Euro, USD, USD Yen, British Pound, USD, and USD Swiss franc, with the potential to make a decent profit. These currency pairs are the most commonly traded and the most liquid. You can add about 34 seconds tier currencies for variation, but only if you commit yourself to the extra research time. With the major pairs, you can spend a lot less time on your computer researching potential trades and more time on other things you enjoy doing. When you consider stocks, you have to choose among 8,000 stocks, 4,500 on the New York Stock Exchange and 3,500 on NASDAQ. How do you pick the stocks you want to trade? And how do you make the time to continually research the companies you pick? Stocks are favored by many as an investment vehicle, but in the past 10 years, stocks have taken on a much more speculative role. Securities face more and more volatility every day, especially with the forces of day trading and other factors you can't predict. How many times have you heard that a large mutual fund was buying a particular stock or basket of stocks, and those trades created unexpected movement in stocks you held? Mutual funds can also influence the market at the end of the fiscal year just to make the numbers look better on a financial report. No matter what some firms may claim, the stock market can be moved by large fund buying and selling, and the movement can take place before you have time to react. It is not uncommon for mutual funds to sell or buy a particular stock for a few days in a row. You won't find these types of problems in spot currency trading. The liquidity of the market makes the likelihood of any one fund or bank controlling a particular currency very slim. Banks, hedge funds, governmental agencies, retail currency conversions houses, and individuals are just some of the participants in the spot currency markets, which are the most liquid markets in the world. Another big advantage spot currency trading offers to traders is that there is no middleman, so it costs less to trade. If you work directly with a dealer who is primarily market maker, you do not deal through a middleman. However, brokers operate through a bank or an FCM, so they may charge additional fees to cover the added costs. In the stock market, you have centralized exchanges, which means you have middlemen who run those exchanges, and they need to be paid too. The cost of these middlemen could be in both time to do the trade and money. Spot currency trading doesn't have any middleman. The traders can interact directly with the market maker for a particular currency who is responsible for pricing the currency pair. Forex traders get quicker access and cheaper costs than stock trading. Analysis and brokerage firms are less likely to influence the Forex market than the stock market. Too many scandals have been exposed since 2000 that show how analysis told clients to buy a stock while calling it garbage and worse in emails behind the scene. These analysts cheerleaders kept the internet and technology moving upward, whereas stock investors unknowingly bought into companies that ultimately proved to be worthless. Currency coin. Wall Street's big brokerage houses paid $1.4 billion in fines to settle charges from regulators that they tricked investors into buying stocks during the boom years of the 90s. The brokerage houses did not admit guilty, but they did agree to cut ties between their analysis and investment banking activities, which shared research. Two-Star Analysis, Jack Grubman, telecom stocks, and Henry Blodgett, internet stocks were banned from the securities business for life. Civil cases related to these charges are still winding their way through the courts. The difference in trading foreign currency is that the primary market for the currency is driven by the world's largest banks and foreign governments. Analysts don't drive the flow of deals in the foreign currency market. All they can do is analyze the flow that is occurring. If you trade in the stock market, you've probably found that there are different costs depending upon how you trade. You pay more fees if you call in your order or ask for specific types of orders, such as a stop or limit order, to minimize your risk. You should not find additional costs when placing an order for trading in foreign currency. We explain how brokers make money on Forex sales in Chapter 15. Margins and leverage opportunities are much better in the Forex market too. In spot trading, you can use your profits on open positions to add to those positions. That's something you might wish you could do when you own a hot stock and want to capitalize on the profits you've made by buying more of that stock. Although it's not possible in stock trading, you can do it when trading spot currency. Forex versus other less risky investments. If you are concerned about the risky of Forex trading and prefer less risky investments such as bonds and mutual funds, Forex trading is probably not for you. If avoidance of risk is your primary investment concern, you probably won't be comfortable trading in the spot currency market. Whether you are trading Forex, stock, or futures, you must be willing to take on risks and must understand that the money you use for trading could be lost. There is no insurance to protect your money except occasionally offered on stock accounts. And you should only trade with money that you can afford to lose. We'll take a look at why currencies change value in Chapter 4. The least you need to know. Most developed country currencies are sold at floating exchange rates on the spot market. You can arrange to buy foreign currencies at some future date using a future transaction. You can swap foreign currencies on an interest stream from foreign currencies using one of three types of swaps. forex swaps, currency swaps, or interest rate swaps. You can get involved in the foreign exchange market without actually buying and selling foreign currency by using options and future contracts. Foreign exchange trading is not for you if you want to avoid risk entirely, but it can be a better trading opportunity if you want to assume risk in order to improve your profit potential. Foreign currency trading offers you 24 hours a day access to the most liquid market in the entire world. Part 2. Deciphering money differences. Many things impact the value of currency. Economics, political developments, changing interest rates, stock news, inflation, expectations, investment patterns, and government policies can all impact the value of money. We talk about how currency's value is impacted in this part. Then we introduce you to the currencies of the developed countries. We review their fundamentals and then give you details on the key times to trade, the most liquid currency pairs, and the key economic releases that move these markets. If you want to explore even riskier forex options, we introduce you to the currencies of emerging market countries. Don't even think about trading emerging country currencies until you have considerable experience trading the more liquid currencies of developed countries. Chapter 4. Why currency changes value.